Now, I'm hoping, I know it's 4:30 and it's been a long day, but I'm hoping for some interaction and questions from the audience. But while everyone's thinking about their thought-provoking questions, I'll a common theme that and comments that permeated all of your presentations was this importance of partnering with the right manager and the dispersion in private markets. You all spoke about how important it is, but what does a good partner look like? What are the characteristics of a good private equity, private credit manager? Because there's a lot of options coming to market. If you're an advisor, you're probably getting 5 phone calls a day from a different private credit manager that's coming and wanting to speak to you. But what does good look like?
I might take a first go at that. I think in private equity, if you hear enough pitches, everyone's mid-market these days and everyone's top quartile, so it's pretty hard not to pick a top quartile manager because everyone pitches themselves that way. At MLC, we've distilled our philosophy when selecting top quartile really to kind of 2 main ideas, which kind of bring it back quite simply is kind of where do you invest your own money, right, is the first idea. And that's kind of how much skin in the game you have. And the second idea is how you make your money. Is it how much you make from management fees, which is just sitting on the money, versus how much you actually have to generate performance, right? And effectively for those 2 components, the greater amount that they can show that they are only getting paid when they have outstanding or outsized performance, we like that. So quite often we will ask for a budget of their management company. How much can they actually make? And ensuring that they're basically break even at the management company level, and they then need to actually generate returns to produce kind of strong economic outcomes for their team and themselves. And the second point is where they invest their money. So for most of our GPs, the standard GP commit or how much they invest in their funds, for the large caps and most managers is probably about half to 1 or 2%. For most of our portfolio, we like to ask 5, 10, 15%, or something that's very meaningful for the individuals involved, noting their personal circumstances. And so that's kind of how we put additional screens onto the typical screens of what is their track record, what's the pedigree of the individuals, have they worked together, what's the market opportunity and supply demand of capital.
So a couple of comments, and agree with all that. There's a lot of persistency in these industries. So the managers who've performed well historically are the managers who perform well into the future. And the reason for that being is that everybody who's looking for money wants to go with a winner. They want to go with somebody who can help them or who can execute on their deals. And there's nothing like historic track record to get future investors, future companies comfortable with dealing with you. The other thing I'd point out is that in these global markets, specialist expertise or sector expertise are really important. So what you'll find, it doesn't really apply in the Australian marketplace because everybody's a generalist, but the specialist managers, who might focus on software, who might focus on roll-ups, who, might focus on, whatever industry, they are the best managers because when you go and you talk to them, they know exactly what you're talking about. And so, we particularly like that. And that's actually one of the reasons why we don't like the Australian marketplace, because it doesn't have that level of expertise.
I can maybe talk about something. Sorry, I've got it mic'd up. Thank you. So I'll talk about it from a slightly different perspective, maybe giving an actual example when we've looked at specifically private equity. And it'll resonate because it's actually exactly what these guys have said. It's the same sort of things. So what we're looking at, and a manager that we're putting into our retail portfolios via a fund and then also offering out on a wholesale basis, is a manager that's been running since 2021. They're about $50 million US. Their staff invest billions into their fund, so it's a substantial investment. Their performance, they started off in public markets, went into private markets. Their performance in public markets has been 20% over 24 years. In private markets, 28%. So we think, skill, if someone has demonstrated skill in the past, they're more likely to demonstrate it in the future. If they haven't demonstrated skill in the past, they're highly unlikely to demonstrate it in the future. But then also, if we have a look at a firm like that, a deep, very, very deep sector experience, But because they have this public and private, what is quite incredible is that the sector specialists on the portfolio side are going across private and public within those sectors. And relatively innovative, you will see this in not just this manager, but there are some managers that use a crossover strategy, which we quite like. This is a bit of diversification in there. Crossover strategy means they're running in publics, and then they're also running in privates at the same time. So you might have 70% publics, 30% privates, or you might have 50-50. But they have a lot of information advantage because they've got the information advantage from the privates that they're dealing in. So we like that. It also gives us a little bit of differentiated there when it comes to how you deal with liquidity, because obviously you've got liquidity, but then also how they structure their performance fees and things like that. They only take performance fees on realization of assets. So we like the fact that they've got skin in the game. They only charge performance fees at realization. And the way they've structured it is fair for all investors. So you don't have this illiquidity or liquidity mismatch. So what will happen is if you take your money out, you can sell down your publics, but your privates go into a separate account, and those privates are held until such time that they're realized. They drop their fees on those, and they only take the performance fee at the end. So it's things like that, but it sort of resonates with what these guys are saying, is that sector experience, how much money have they got in, what is the skill. That's just an example of one that we're actually working with right now and that we have going into portfolios.
And then maybe from our perspective, there's probably three things that we'll look for. So one is sort of institutional quality in their platform. So just the types of capital that we're entrusted to use. We can't afford to be in situations where there's a certain level of operating risk for these teams in terms of keeping key staff, in terms of how they do platform or business related workings, calling capital, managing our capital, etc. So that's like sort of a prerequisite for us. We're not in a position where we're going and backing necessarily brand new emerging managers just from the risk profile of our capital. I think the second thing that's quite important for us, it's sort of style. And so we're co-investing alongside alongside these partners. They need to have expertise, track record, that's all really important. But it's also how they go about it that's really important to us. And so we'll look at how they underwrite their opportunities, how they're thinking about delivering return, how they're going to get from A to B, and make sure that sort of aligns with how we go about investing in our business. We don't want to be misaligned with somebody as to how they're going to extract value, the underlying approach to running a business, how they think about workplace health and safety, how they think about ESG, how they think about sort of the ethics that sit across their investments. So there's sort of the other things that we'll look at. And it's hard to explain, but it comes out from going through it with them. It's very rare that we're going to make an investment it's impossible to make an investment without really interrogating all of this with the team, and that's quite time consuming. So that's why you have to be highly selective.
Fair enough. I have to do it with. It seems that the underlying theme for all of these investments is sort of interest rates to some extent. Is the major risk with the investments, whether it be PE or private credit or infrastructure, the rapid change both up and down around that and how that impacts the projects? For instance, like 2022, obviously that impacted a lot of the exits in the PE space. I think from some of the renewable projects that sort of impacted the returns that could be generated. Is that the sort of risk that we're dealing with?
I'd say interest rates definitely have an impact on the overall market. Like at MLC, I also sit on the infrastructure investment committee, so I see kind of all the deals that they bring across on that side of the table and how it compares to what we're seeing on the private equity side. Within private equity, basically the larger cap you go, the more interest rates play a key role into generating successful returns. In the mid-market, leverage, as I mentioned before, typically is less than a quarter of returns. And if I look at probably like the last dozen deals I've led at MLC, because of the change in the cost of capital and the increased cost for mid-market companies to raise kind of private debt and private capital, we've actually done about half those deals, or I've led about half those deals with no leverage on day one, which I probably haven't done for a decade, is bring IC to the IC deals where we didn't have leverage day one. And the logic is that if the company's growing kind of in the mid-teens, we can generate our returns through other levers. And if at some point the capital markets become more attractive, we can then add leverage to the company closer towards exit. But I would say in different asset classes, and the larger you are in terms of the deal size, the more interest rates have an impact.
Yeah, so I'd say that the major impact of interest rates on the mid-market has actually been in the ability to exit. So it's actually on the buyers. So multiples are depressed because of where rates are, cost of capital, etc., which has meant that future buyers are not willing to pay the sorts of prices that the private equity firms want. And that's why you've seen a real drying up of exits in the market. So I think as rates come down, you're going to see the exits. And I think the valuations are still there. I think somebody mentioned before, nobody's selling at the moment because, why? You don't need to sell. So I think that's put a real dampener on the market, but hopefully it's just a timing issue. In private credit, mid-market global private credit, almost every loan is a variable rate loan. So you find that the spreads usually stay the same, but will go up or down as rates change. And most investors are comfortable with that, or most investors understand that when they go into this, they're going to variable rate return. So so that works for them.
Quick question from me. Thanks for your presentation. It's very insightful. Somebody mentioned 15% allocation to private markets in the future fund. Do they have their own teams, or do they put out RFPs to managers?
Yeah, most of the large programs, so I would say maybe the top 5 super funds, all run money in-house, including MLC. So basically Aussie Super, Aware, or ART, us, Future Fund, all run in-house teams of, I think, Future Fund's about 30-odd people in private equity. Aussie Super's maybe 40 to 50. Typically the smaller super funds outsource that because they don't have the scale. They might have 1 or 2 people to manage the outsourced providers, but they won't have the capability to do that in-house. And so I think the trend, if you look across the industry, is more in-house, but then also more direct. And so the role of LPs is less so much allocating to funds, but now doing direct investments alongside co-investments and then secondaries as well.
I think what they're doing as well, they've got the in-house teams, but I think they buy in research or they engage with one of the big allocators to get their research. So I think Future Fund does that as well as having a big in-house team.
Yeah, I think a few other points to add. You've sort of seen the Aussie supers follow some of the Middle Eastern investors, the Canadians, some of the big US investors in terms of that balance between in-housing versus relying on others. And I think, especially in Australia, like someone like Aussie Super went quite aggressive to in-house. You've still got to be able to originate your opportunities as well. And so what you find, some of the Singaporeans or the Canadians, they will still lean on their partners or their GPs with fund allocations in order to create deal flow. But then they're able to invest very large checks alongside them almost as equals into opportunities. They might not get access to those opportunities, without those partners, because it costs a lot to have an office here, there, overseas in various different markets, and it's a very relationship-driven, boots on the ground type investing style.
Hello. I'm just interested to hear your thoughts on recent ASIC look-in on private markets, especially in the wealth space, and what you guys are thinking around that and how that'll impact private markets long term.
Sorry, I missed that.
The recent news around ASIC looking into private markets a little more heavily in terms of regulation.
Yeah, I'm happy to.
Yeah, go for it.
So I think it's great, right? I think there is a lot of noise in the market. There's a lot of bad actors. I don't see any of them in the room here, thankfully. But I think there are, sometimes we will see something or get a prospectus and we go, wow, how did anybody do this? how they're able to do this. So I think a cleaning up of the industry actually is a really good idea. And I think the people who come out, who do things properly will come out, shining. Hopefully ASIC, have the proper process and procedure, but I think that will happen. In the meantime, it's a very painful exercise. I mean, we've got people spending hundreds of hours answering, questions that are, way over the top. But, I guess that's the nature of the regulator.
I think we from our perspective, we 100% agree with Russ. It needs to happen. I think there's an education requirement as well for the participants with ASIC as they're going through this process. But I think it's actually good for the industry. And it needs to happen because there's a lot of opaqueness there. And when you've got consumers, especially retail consumers, and you've got illiquidity and you've got potential liquidity mismatches, those sorts of things, it can drive the wrong outcomes. And the optics when something goes wrong is bad for all of us. So you actually don't want that taking place.
Question from me, guys. Just around pricing, we're talking about managed accounts and private markets, quite often illiquid. And there's a real push that we see for people wanting monthly pricing. Very hard to monthly price something when the underlying funds or the underlying assets may only be quarterly at best. And we see a lot of movement into people pricing monthly around benchmarks, which is probably going to require some adjustment down the track. How do you sort of feel about that monthly pricing on it as a guesstimate or estimate based on benchmarks, and how do you see best practices of working around it?
Well, I'm happy to go from our perspective first, maybe. So I think, where there's a mismatch like that, we don't like that at all. So we will stay away from that. There's very few firms that can do accurately monthly pricing because just the valuations are not there. And if you're getting third parties to validate that, it doesn't happen. So I think from our perspective, if you're doing this to be fair to the investors, you need to price what can be the underlying pricing can be done at the GP level. And then you can flow that through. And if that happens to be quarterly, then it happens to be quarterly. If it's half yearly, it's half yearly. It's not necessarily convenient, but I think going the other way is actually much more risky for the clients coming in.
Can I maybe try to be a bit provocative with this group as well and see if it teases out people to agree or disagree with me? One of the points I made earlier is you're not owning like public markets, you're owning a fraction of a business. Someone might be selling today because they're settling on their mortgage on the weekend and they're a price taker, and that's the market price. The businesses that we're talking about here, the way that they're valued, the way that they're thought about, the structure, the governance, there's not a lot that can happen today to a business that makes it materially different to what it was worth yesterday or tomorrow. Now, there are obviously changes in terms of regulation could come along, you could lose a big supply contract, whatever it might be. But the way that the assets are valued is relatively uniform across the market. And somebody made a comment earlier today about you don't actually necessarily know what the market will pay until you run a process to sell it. And so the point that came up around, is it reduced volatility? Is it sort of fake reduced volatility? I think it's quite an important one to flesh out and explain to people that, like a lot of maybe the people that you manage money on behalf of, if you've run a small business, that person's not going to think their business is worth any more yesterday as it is today. And you need to sort of be able to bring that into the process. Obviously, you can't say we'll value a company once a year and just hold it flat for that period of time. There's a bit of noise that needs to come through, changes in interest rates, changing in borrowing costs, actual performance and whatnot. But fundamentally, in my eyes, businesses don't materially change in value day in, day out, or even month in, month out. And so there needs to be the right balance when you're bringing it as part of portfolios.
Yeah, so I'd say private credit, it's not an issue. They're yielding assets and you're just, accumulating the yield. So I think that's a bit of a non-issue in private credit. Private equity, it's absolutely an issue. I mentioned in my presentation about the advantages of a listed vehicle. I think the only way you can really fairly do this is in a listed vehicle where somehow, and it might be right or wrong, that there's a supply-demand mechanic in there and a price is found. And whether that's reflective of the underlying or not, who knows? But you're able to accurately price it on that basis through the quarter. And then obviously valuations come through and you see a new NAV, etc. But that's actually okay from a regulatory perspective. All types of pseudo pricing that you're putting on it in the interim, I just don't know how people get comfortable with that sort of stuff.
I would make one extra point there, and I don't disagree necessarily, but maybe it's just a different way of looking. I think as you said, private credit, that's one thing. I think infrastructure is another. PE is an issue because if we look at 22 and we had the question about interest rates, if you were at that point in time, you had those interest rates going up and you were in certain types of PE, more than the growth side, sometimes the larger cap side, those needed to be marked down. There were no IPOs, there were no exits. They had to be marked down. If you went and you had a sophisticated investor, they can arbitrage that if you haven't marked those down. So I think there is a risk in certain markets that you have to be really careful about how you value these. And if you look at some of the really good PE funds overseas, they are extremely good at valuing. They have very, very large teams there that do the valuations, and some of them actually do it on a monthly basis. And that's what we would prefer to do, is to reflect that rather than say there's a general there and they won't change price. I think because they do, under certain markets, change price. And when that happens, you can get an arbitrage.
I've got a question about private credit. When I was a much younger man, I ran National Australia Bank's hire purchase business in New Zealand because the RBNZ didn't like the bank lending HP money, and so we had a different business, which the bank owned. The thing which has always interested me about the discussions about private credit is why are the JP Morgans and the Chases and the Bank of Americas not heavily involved in this, but not through the bank arm? Why have we seen new lenders emerge, given I would have thought the corporate relationships which mainstream banks would have had? It's not, so it's a question of interest rather than directly relevant to the PC market.
Yeah, different.
Yes. So there's two types of, from a regulatory perspective, two types of banks in the US. There's those major banks, and then there are literally a few thousand small banks. We kind of find that weird in this market where we've got half a dozen banks, right? Or I don't know, 8 or 9 banks in total, right? But there are literally thousands of them. And every week, a couple of banks go bust. The regulator is extremely concerned about contagion from those small banks, and it's happened. There's in the history of the US, like there was the savings and loans, debacle where a whole bunch of these things went over. You saw when SVB went over, another couple of banks fell over as well. It's a terrifying thing for the regulator. So the regulators actually, I forget what they call the two segments, but there's the big ones, and there's only a handful of them, and then there's thousands of others. The big ones actually have a lot of ability to do more lending, and then the thousands of others, that's where they've really crunched them and said, we want you to get out of this market. But there's only so much the big banks can do. There's capital efficiency that they want to deal with, etc. They'll focus on the big ticket stuff, and actually what they like to do from a capital efficiency perspective is go out and do a really big loan and syndicate that loan out. That's the business and they love that business. Make a turn on their capital and put their money to work again. So this whole mid-market lending thing, which used to be the domain of these smaller, medium-sized banks, that's the part of the market that's disappeared. And I think private credit has been so good at seizing the opportunity that they've captured it. And there's no banking segment that's really able to compete with that. It's an interesting dynamic.
It comes down to the regulatory capital that they need as well. So there is some places that they will be far more competitive than any private credit source. It's within the box. They have their credit models. They go, bang, that's what I lend into. But it's really interesting. The Goldmans, the JP Morgans, they'll all have private credit divisions within their asset manager. So it's not using the bank's capital, it's using third-party capital, and then they're using their broader network and relationships that comes from the banking side in order to find those opportunities as well.
Just bring it back to the implementation just quickly. Kieran, you spoke about within your business creating appropriate liquidity to get private assets into your MDA structure. Is that a daily, monthly? How have you? I guess what level of liquidity have you provided? I guess because there's a lot of businesses and obviously platforms that come into the party around now being able to tolerate monthly liquid type structures. Whether you should or shouldn't put those in those structures is another question. But what have you done in your business and what level of liquidity have you required?
So I think the first thing to make is to make a point, though, that it's only our clients going into these, and 95% of our clients are under discretion. So that is a very privileged position to be in, that type of control. So when we put them in, typically, if we look at our alts programs, both defensive and growth, they're monthly liquidity. And we've been able to work with a number of the superannuation trustees to give them comfort that they can meet their regulatory hurdles of death benefits, all of those sorts of things. They can make it. We can definitely pay that out within the fund. There are some questions around how long would it take to liquidate the whole fund. And typically, you need to get them comfort on that as well. When we look at some of the private equity stuff, so we've got a little bit in there at the moment in global. So we put in global PE, global equity, and in Aussie equity as well. What we're doing there is we have a fund structure that would have like a growth fund, number of fund managers, so it's more satellite. And we would limit that to like 10 or 15% of that fund. So if that fund has got 500 million in, we would do 50 million in PE, because we know the liquidity is then run outside of that. So that's the way we do it, which is a really simple way of doing it. Much more difficult, though. You'll have to put a lot more in place if you're going to go to the general market with that, because you can get those horrible skews when people move out very, very quickly, and you go from 10% illiquid to 50, 60, 70% liquid like we had in the GFC. And then, so you'd have to gate that very carefully.
And our products are at the opposite end of the spectrum to Kieran, where we've got outside investors in them. We need to very carefully, depending on which product it is, whether it's our listed product, our SMA product, our unit trust product, got to very carefully design what sits in the product in order to make sure that we've got the right levels of liquidity. So we actually agonize over that. And all private credit solutions or funds are not the same. So if you want to have, for instance, more liquidity in a vehicle, then you want to invest in, some direct managers who might have underlying, monthly liquidity, and there's a bunch of them that do, but you won't be able to invest in managers who have got lockups who might generate much higher returns. So there's this trade-off between risk and return, or longevity and return, and you have to, as I say, specifically design every product to make sure you don't disappoint your investors.
At MLC, we have a range of products, and I think when you're looking at private equity and talking about liquidity, there's kind of really two approaches. So we have, for example, closed-end 10-year lockup vehicles where we kind of promise 15 to 20% returns, and then we ask kind of those allocating to it to make sure it's kind of your last source of liquidity. So allocate 5 to 10% of your portfolio, but liquidate everything else first if there's a downturn, and this is the kind of asset that you try to hold forever or until the end of the vehicle. The other approach is we do have quarterly redemption vehicles as well, which are evergreen vehicles. And the way we structured that to ensure that there's always liquidity there, even though, like many of our peers, there's a 5% cap on the quarterly redemption, we've actually structured it so MLC as an institution has a kind of significant seed investment into that product, and they will effectively provide backstop liquidity to all the retail investors. So even if all the retail investors try to redeem in that vehicle, we could actually allow them to all redeem, which is quite unusual. But it is something you have to be mindful of, is even though a lot of these vehicles say there's monthly or quarterly liquidity, is that liquidity there when you need it, which is when there's a downturn and everyone wants to redeem at the same time.
And just to clarify, that's monthly redemption for that structure. So look, yeah, I think summing up all this, and I'm appreciating we're at time, unless there's any final questions from the floor between you guys and drinks. But look, I think to sum this up, obviously we've heard perspectives from a vast range of experts talking about different asset classes. I think the onus is on everyone in this room and is doing your due diligence, educating yourself on these asset classes before jumping into any of these solutions, really understanding who are the clients that you're allocating to or for, because whether they make sense to sit inside of a managed account structure or outside, we really need to be mindful of the liquidity profile of these different investments. But if everyone can just thank me we've got Kieran Canavan from Centric, Findex Apologies, David Chan, MLC, Russel Pillemer from Pengana, and Adam Roberts from Australian Ethical. Thank you, gentlemen.